Al, we're live.
We are indeed, my friend. We're back at it after a slight
Well,
hiatus.
it is September 27th, okay? September 27th, we got a lot going on. We got a show to bring to the world of YouTube and Instagram, all of those social media platforms. You can find us just about anywhere. ThatMortgageShow.com, ThatMortgageShow, HTTP semicolon hyphen / thatmortgageshow.com /.us. Al, what do we got today? What's on the docket?
Yes, we're going to be talking about a lot of stuff. We've had a lot of things happen, right? A lot of exciting things going on. We're going to be talking about dot plots, okay? We're going to be talking about jobless claims. We're going to be talking about housing price index. We're going to get into some hot markets, and then we're gonna finish this thing off with refi applications. I think so. That's what we got lined up.
That's what we got lined up.
For the next 30 minutes. Join us on this ride.
Join us,
please. Sit in the sidecar.
Yeah. Keep your appendages inside the cart and no flash photography. Let's go. All right, so first segment, first thing that we're going to talk about is interest rates. What's your rate? Alvin, everybody's been talking about the Federal Reserve. Everybody's talking about it. We were talking about it. Everybody by now knows what they did. They cut rates by 50 basis points. What people don't seem to realize or may not understand is that mortgage rates actually went up in the immediate aftermath of the rate cut, and they've kind of maybe plateaued, but even as somebody who's in the industry, for the weeks leading up to the Fed rate cut was one of the people that was saying, 25 basis points baked in, 25 basis points baked in. I thought that the Fed was going to cut by 25 basis points and we were going to see absolutely nothing happen. When I saw that 50 basis point cut, I was excited. I thought it was going to mean, I did think it was going to mean lower rates. I don't know. Why wouldn't you think that?
Right.
What did you think? What do you think about how that transpired?
So everything that I read, and the people, some of the people that I followed, I assumed the same thing. But some of the people that I followed, even before the rates, before the Fed rate cut, had said, well, you're going to have to explain. People are going to have to explain to their borrowers why rates are going up, or to potential buyers why rates are going up after the rate cut, right? Mm-hmm. Basically because all the, basically once the Fed announced months ago that they were planning on cutting rates, or they alluded to it, then that's why we saw rates start to come down pretty drastically too. And so that was, that initial drop was the reaction to the rate cut, not necessarily after the actual rate cut happened. I'm a little perplexed, if you will, that we saw a 50 bip rate cut instead of 25 basis points. I probably would agree with you that I thought that would have an impact, on rates coming down a little bit lower, but not the case, I guess, because some of the other data that goes into that. But I'll let you chat about that data.
Yeah, so
the rates to go up.
It's funny because you can read multiple different experts' opinions and they all say something different. So who's right, who's wrong, who's the actual expert, who is just blowing smoke. So some explanations as to why the Federal Reserve cut by 50 and rates went up include the larger rate cut spooked investors into thinking, ooh, the Federal Reserve knows something we don't. Cause for concern with a recession. Oh, is the Federal Reserve getting super aggressive right now because we're heading toward a recession? They're trying to prevent it. Is the Federal Reserve making the wrong decision and cutting so quickly, too fast, too much too fast? And is that going to spark or rekindle inflation. So those are some of the things that I've been hearing folks say as far as explanations to why. In the past, 50 basis point cuts have caused the 10-year Treasury bond to tick up slightly in the immediate aftermath and then go back down. So we'll root for that. It all depends. In the short term, it's going to be hard to guess what's going to happen. It all depends on economic data, specifically the labor market. So yesterday, an important report came out. The initial jobless claims report came out. And let's see. So here we go. We've got a nice little graph showing. Can you see it? All right. So we've got, this is the last 8 weeks of jobless claims, and you can see that has been trending down. So I should say initial jobless claims are the amount of people that are claiming unemployment, looking for unemployment income for the first time. So these are people that have been laid off, fired, who are entering the unemployment claims space. As these numbers go down, that is a good sign for the labor market.
Right.
You'll remember from late July, the initial jobless claims was peaking. It was at like 3-year highs. So it is good to see the labor market is recovering. I don't know if it's because people aren't getting fired, but they're not getting hired, so there's not more new claims happening.
Right. Yeah. People aren't leaving their jobs. People aren't getting hired to jobs. We'll stagnant. We'll stale. Especially when it comes in under the, what's projected, right? When they expect for higher jobless claims, and then it comes in lower, typically, when that's a little bit higher, you'll see, that negative data as far as jobless claims turns into positive, a positive outcome for interest rates. Interest rates tend to come down a little bit lower. So
what this report did yesterday was it caused the 10-year Treasury bond to jump a little bit, because it's just a sign that things aren't as doom and gloom as they may have been thinking. Like you said, when these numbers come out less than expected, when they're expecting, for example, last week was 250,000 jobless claims. They were expecting 240 this week. It came in under that at 233. So that makes economists and I guess policymakers feel warm and fuzzy about the labor market. At least it staves off like the recession is a foregone conclusion. So I guess this shows that it's maybe still up in the air.
Possibilities.
Mm-hmm.
We're not rooting against America. We're just rooting for. We're not rooting against the economy. We're just rooting for low rates, right? So
right.
You got to clear that line.
And as far as mortgage rates goes, it's just going to be impossible to say certainly what's going to happen. In the short term, I think we can just expect more volatility.
Yeah.
In the long run, it's probably safe to assume that rates are going to be moving lower over the next over the next 6 months, over the next 2 years. Rates are going to be moving lower, and the Fed has been quite clear about that, and possibly no more clear than the most recent dot plot, Alvin.
Get out of town. You got a dot plot for us?
Dot plot for us. There's a little dot plot up here.
Yeah, the volatility right now, like you said, we can expect rates long term to come down. Right now, it's going to be akin to, being in a dinghy off the coast of Florida, right? A little up and down, right?
So I don't know if you can see. I don't know if you can see the dot plot. How can you see the dot plot?
I can see the dot plot. Everybody can see the dot plot.
All right, so you can see the dot plot. All right, so every quarter, Federal Reserve officials get together and they make their predictions or projections on where they believe the federal funds rate should be. The federal funds latest dot plot is on our screen. This is the September dot plot, and you can see that it goes all the way out to 2027 and indescript longer run. So let's stick to 2025, 2026 area here. So the Federal Reserve is projecting another full percent in 2025. I should start here in this year. So the Federal Reserve's latest dot plot projects another 0.5% cut for the year, another full percent in 2025, and 2.5 percentage points of interest rate cuts by the end of 2026. This would move the federal funds rates from its current roughly 5.25% down to 2.75 by the end of 2026.
Mm-hmm. Yeah. Now we know obviously that's not going to directly transition. It's not like rates are going to come. Mortgage interest rates are going to come down to 2.75 or 3%. But the expectation, as always, is that as that comes down and the 10-year Treasury bill comes down, that mortgage interest rates follow that, right? So they will, right? Hopefully, we assume.
Yeah, I think it's safe to assume if you can look at all these dots on here are just people's votes. They're Fed members, like they're putting their dot. Picture like each individual coming up and putting their dot on this chart. Mm-hmm. So it's for the timeline. It's showing how many members voted for what rate. So
mm-hmm.
and
they blindfold them, they spin them around, and they pin the dot on the plot.
Yeah, and they all sing a song, and then they go to Bohemian Grove and they worship an effigy of an owl.
So that's the way it works.
That's the way it works. So good point, Al. Just because we're saying that the federal funds rate is going to get down to 2.753% by 2026 doesn't mean that we're ever going to see rates in the twos again. I don't think we will. I don't think anybody in the industry would ever say that they expect rates to be that low again. I think
I don't think we want to as folks in the industry, because as much business comes from rates being that low, obviously there has to be a bounce back the other way, right? That pendulum is going to swing back the other way. So we'd rather have pretty consistent, stay between 4% and 6%. There's always opportunities there to buy houses, to refinance, to access equity, things of that nature, without necessarily going down into the 2% interest rates. So.
Yeah, I think I agree wholeheartedly with you. Rates in the twos
I remember
would
you
mean
saying that too. I remember you saying that back in 2021. You were like, "These rates need to go up. This is bad." And I was like, "What do you mean?" You reach up, like you just pull money off a trade, right? It was just deals, right? And you were like, "I'm telling you, it's not going to be good. It's going to bounce back the other way." And I was like, man, it's going to be like this forever." Woo! And you were right.
Yeah, well, I remember trying to help my clients with purchase negotiations, and the biggest,
that was the flip side of it. Yeah.
The biggest red flag was the introduction of and normalizing of appraisal waiver, appraisal gaps. So where a home under appraises. You go into a contract to buy a house for $300,000. It appraises for $270,000, and it was a must. If you were going to get a contract accepted, it was a must to have it in your negotiations that you, at least in Maryland, like I think it was everywhere, but you had to include an appraisal gap contingency where it's like, I'll cover if it underappraises by $20,000. We'll come to the table with that cash. We're still going to make you right, Mr. Seller. And if it appraises to $270,000 and we agreed for $300,000, I'll make up the difference in cash. Before COVID, before the two rates in the twos, that was like not something that was advised. And then it went from don't do that to you have to do it. That's weird for me.
Right. When you have that many offers going in on the house, and the amount that people were offering over asking price, right? There's no way that these houses were going to appraise for that. But then after you have a couple of them sell, right? Everything these values are based off of sales in the area, so you saw these values just really skyrocket and take off. And then once the rates followed, now you get to this point where we are, where we've been in the past 2 years, where affordability is just, terrible, right? It really, really shot up. So. Hot shot plot.
Why, why don't you kick us into, all right, so from there, I think that's actually a good segue. I think it was, I guess, an accident talking about house prices
There's
and
no accidents
waving
here, Ev. There's no
and
accidents.
waving waiving your appraisal gap. But why don't you take us into our next topic, which is housing prices?
Housing prices. Um, yeah. So there's apparently if you go on YouTube, you can find tons of people warning of a crash. Is that the case? You heard this?
Yeah, yes, yes. At least my
Could be
algorithm.
because of fear and dramatics,
That's my algorithm definitely
right?
is pumping uh, doom and gloom.
Just
You
yeah,
good? You with us?
absolutely. It sells. Fear sells. Yeah. Can you hear me? You got me?
You're back. You're back.
Okay. Cool. Sorry about that. Anyway, yeah, fear sells, right? Fear gets likes. You know, people talking about everything's going great and positivity doesn't. You know, that doesn't sell. That doesn't get likes. Fear gets likes. Um, but
Yeah, so
what is going on?
I think what we're getting at is if you go down the wrong rabbit hole, you might be led to believe that everything is the sky's falling and housing prices are crashing. But a recent report by the FHFA, the Housing Price Index, in July, indicated that prices are actually up month over month, and year over year housing prices are up 4.5%. Monthly price changes from June to July varied by region, but the highest increases were in the East North Central region, which I had to look this up myself. East North Central region is Illinois, Indiana, Michigan, Ohio, and Wisconsin. So the biggest month over month jump in value was in those states. The
Yeah, that's
largest
crazy.
the largest decrease is in the South Atlantic. It was about minus 1%. Over the past 12 months, all regions have seen an annual growth. So all regions have seen annual growth. Again,
Yeah.
East North Central is up 7%, New England's up 7%, Mid Atlantic's up 6%, East South Central, where you at, is up 5%, and then that trickles down from there.
Rapid dog. You know, which begs the question, and I think it's a question that everybody's kind of pondered at some point: is how high can they go, right? How high can these values go? At what point? I mean, it can't keep going up forever, right? At
Hmm.
this rate, there's going to be some point where a 2,000 square foot house, and you'll see it in California in some of these really these booming markets or these places where values are just astronomical, $1 million for an 1,800 2,000 square foot 3 bedroom 2 bath, right? So how long does it take for other areas to catch up to that, and at what point does that kind of slow down or stop? Obviously, having rates come down, right, and the demand, which is going to drive demand up, is certainly not going to slow it down at all. So I'm curious to see when that happens, right, when things kind of plateau as far as values go.
Yeah, I mean, I don't. It may plateau for a period of time, but unfortunate for anyone trying. I don't know if it's unfortunate or fortunate, but it always goes this way. It's just always where
Yeah,
it goes. So
always goes up.
the thing is, if housing prices are going to remain stable, with if they remain stable with declining mortgage rates, maybe it'll help improve affordability. If home values, they're up depending on what region you're in, from as little as 1.5% all the way up to 7, almost 8%. Depending on what region you're in, if prices have stabilized and rates come down, it could help affordability. But Al, you made a good point when we talked earlier about affordability and mortgage rates going down. So, what did you say earlier in that?
So basically, that as mortgage rates come back down, right? You're going to have a lot more people that are going to be looking to buy, right? You have all these people sitting on the sidelines that are going to want to buy. Demand is going to be up, and you're going to go back to, I don't know if it's going to be as bad, but you're going to go back to that point we had in 2021 where you had all these offers on one house and people looking to pay over asking price. That's just going to drive values, really, really escalate values farther than the market will just kind of naturally progress, right? You're going to have this demand just really pushing the values up higher and higher.
Especially if the inventory issue isn't solved,
Right.
which rates play a role in that too, because as we all know, and we've been talking about for a year or two now, is the golden handcuff. So like that's part of it too. Hey,
Yeah.
I've got an idea. We're gonna divert off path here, and we're gonna like, hey, clip guy, whoever's gonna make our edit our clips out. Why don't we get a nice clip going? So insert
Clip it.
suspense, insert suspenseful conspiracy theory music. Al, as far as values go, as far as home prices go, what do you think about Kamala Harris's $25,000 first-time home buyer credit? What will happen in the housing prices and the housing market as a whole if people start getting $25,000 to buy a house from the government?
It's the greatest thing in the world, Ev. I think it's fantastic. I think that everybody's gonna be able to buy a house. You're getting a free $25,000. What's the worst that can happen, right? Number one, where's this money gonna come from, right? Are we should drive ourselves further into debt? Thought. Number two, if everybody's getting $25,000 to buy a house, and they're just going to increase the price of the house by $25,000.
Ding ding
right?
ding 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 ding.
Sell it for $25,000 more. Get as much as you possibly can.
I think that's the takeaway, and that's what I was hoping you would say.
I know what you were hoping I would say, but sometimes I'm not just going to follow the breadcrumbs down the trail, right? Sometimes I want to peek around a corner and see what's there.
Yeah, sometimes you're the king of peeking around corners and seeing what's there. Most of your life is peeking around corners. All right, let's jump into the next segment here. Next segment, I've got something fun.
Dot plot?
Nope, it's not a dot plot. It is a heat map. The hottest real estate markets in Q3 of 2024 provided in the I don't know shit. In the stylings.
Roll too. Fast.
Heat map, the hottest real estate markets in Q3 2024, brought to you in the stylings of a heat map. So, yeah. All right. So, you got some hot spots. You got some hot spots here. Let's leave that up and we'll talk about it real quick. So, Al, I'm gonna ramble here for a second. So, the top 100 hottest real estate markets in the U.S. are mapped as you see here on your screen using Zillow data, and it reveals some notable trends. So I'll go over some of these trends with you. There's a geographic shift going on. Unlike last year, these markets are less concentrated in the eastern U.S. Several major cities in the western coastal states, particularly in California, showed strong growth. So if you remember, post-COVID, there was the exodus from California, and prices kind of maybe leveled off, normalized, or even went down. So they're going up. My favorite stat about this right now is small cities are dominating. The majority of hot markets are smaller cities. For example, Blytheville, Arkansas had a 16% jump in home prices. We saw Greenville, Tennessee, Rockford, Illinois, Pottsville, Pennsylvania, all up over 10%. Yep. And then while these secondary markets are exploding, appreciation in top markets, big cities, has declined sharply. There were a couple large cities that did make the cut, including Los Angeles, San Diego, San Jose, Boston, Hartford, and Rochester. So California and the Northeast.
Always booming. Always booming.
Got a baby crying?
Mm-hmm.
So if
Anyway,
you here
go
Al,
ahead.
so can you see this? Can you see?
I can see it. I got eyes on it.
All right, so let's go to a couple spots and you tell me what you think. So all right, so this is a hot spot. What do you got there?
Statesboro. Ooh, Statesboro market
Statesboro.
is hot. Who doesn't love Statesboro?
There's
Oh, the
Greenville.
wrestling team. Yep. Greenville, Pottsville, Transylvania, home of Dracula. All these
There's
places
Pottsville.
that you would never expect to be booming markets, but you love to see it, right? These smaller areas
Syracuse.
starting to boom. Syracuse saying, yeah.
Syracuse. So the median. So
Median
let's
home
go.
price 236. So that's another interesting thing to look at is these median home prices. Syracuse, New York, what was it? 236. Pottsville, 142. Annual price appreciation going up that much, and it's still only at Statesboro 160, or was it 260?
Mm-hmm.
260. Now go out to some of these spots out in California. Let's see what they look like.
Look, Great Bend, Kansas.
Yeah,
It's
you could
it's
get a
booming,
McMansion. You could get a
dude.
35. You could get a 20,000 square foot house on 35 acres for $700,000.
Oh my God! So the median. So here, Great Bend, Kansas. The annual price appreciation was 12%. The median home price is 112,000. So if you're looking to get into real estate investing, if you're looking to maybe buy a rental or even move to a place where you work from home, you can work from anywhere. You want to go live in a place that's up and coming, and you're worried about affordability. Well, Great Bend, Kansas, you can get into a house for 112,000. Shoot. What do you imagine what a $400,000 house looks like? Dodge City is up 11%. Median home price is 206. Hey, everybody's been talking about how they want to get out of Dodge. Why don't you get into Dodge? And I'm not talking about Chrysler.
Dodge.
I ain't talking about Chrysler down there on Pulaski Highway. I'm talking about Dodge, Kansas. Dodge City, Kansas, baby.
Dodge. You just made a great advertisement for Dodge, Kansas. Dodge City, Kansas.
Blytheville, hey, we got Blytheville's up 16%, and the median home price is under $100,000. If you're an investor and you want to get a rental, I don't know, maybe you take a shot at Blytheville, Arkansas. Maybe you call Adam and Al to do a cash flow investor loan for you. You don't need to provide any income. You don't need to provide any debt. All you need is a credit score and a down payment, and you're in.
And down payment. Got a little cash in the bank and a decent credit score and a pulse. You get yourself an investment property for $92,000.
Mm-hmm. So if you are thinking,
I really wanted to see that California markets, but
oh shoot, I'm sorry. Hold on, let's go back. Let's go back. I got it.
It's California. I want to see what the values look like out there.
I'm sorry. I got really excited. Here you go, baby. Put it on us.
So there you go, right? San Jose, that median home price, $1.6 million. Median home price. That is, oh my God, $982 in Santa Maria, LA, a mil. Jeez Louise. So yeah, places.
And then you've got all, I guess all the poor people live in San Diego. 957,000 median.
Them San Diego folks, I mean, they got investment properties down there. They got investment properties in LA.
Mm-hmm.
That's insane.
Yeah, crazy. All right. So if you are investing, if you are a real estate investor, please do hit us up. If any of that excites you and you want to take a look, we can help you. Something to keep in mind.
DSCRs, we got the bank statement loans for those folks out there that have a ton of money in the bank that show $12,000 a year on their tax returns. We got you. We'll get you. We'll get you into the house.
Yeah. So let's move on. Al, I want you to take the reins on this one. I'll tee this up for you. I'm gonna get the screen share going for you. You just take it from here. All right, what do you got?
Yeah. Mortgage apps, 2-year high, right? refinance surge. We knew this was coming. We talked about this coming. We said that as soon as rates came down, obviously the folks that purchased a home in the past 2 years bought at a higher interest rate, so there was opportunity there to kind of ride that wave back down and simply lower your interest rate. And then also you have the folks who have accumulated a ton of equity, right, and have just gotten beat down by inflation and the high prices of everything, and have racked up debt, personal loan debt, credit card debt, whatever the case may be. Those folks are looking to refinance now because there's finally a rate where they can stomach, going to the fives or sixes, as opposed to 7 or 8%. So you're seeing these folks looking to refinance, looking to access the equity in their home. It's not surprising. We knew it was going to happen, whether folks were refinancing just to lower their monthly payment and their interest rate, or they were looking to access that equity to consolidate debt or get cash out to take care of home improvements or things of that nature. So, I think we have $2 trillion of consumer credit card debt right now in the country. So, this is when you're really going to see it. As these rates come down farther, you're going to see a lot more people looking to utilize the equity in their home to pay off those bills, right? And eliminate, 18, 20, 22, 25% compounding daily interest on credit cards, and kind of move that under a nice tax shelter of their house, where that interest is tax deductible and working for you a little bit more. So, not too surprising.
According to the Mortgage Bankers Association, refinancing applications jumped 20% for the week ending in September 20th. So this is last week. So I bet you this week's probably even a little higher. So it's funny because mortgage applications, refinancing applications have gone up since the Fed announcement, even though rates went up a little bit. So It's like all perception, which whatever.
Well, I mean, it's the news, right? It's the news. Everybody saw the news of, oh my God, the Fed cut rates, and so naturally, folks that aren't in this industry think, well, they cut mortgage rates, right? They have no idea, what the things are that kind of help or have an impact on mortgage rates. So they just hear rates got cut. This is the perfect time to do it. Whereas we've been kind of screaming from the rooftops for the past month, like they're slowly coming down. This is the time to do it. But yeah, it's about what you see on the news and the things that come across your feed. Like, oh my God, the Fed cut rates. It's time to do it.
The greatest marketing tool of mankind is FOMO, fear of missing out. People fear missing out more than they I don't know, want their tasty treat. They fear.
And how many people? Go ahead.
I don't know. I was going to come up with some silly anecdote.
You're so silly. But how many people have FOMO now because house values they thought were too high and it was too competitive in 2021, right, to buy a house in 2022, and they were like, I'm going to wait until the housing market crashes because it's definitely going to happen, right? Things are going to go south. So how much do those people have FOMO now?
Yeah. Dude, I have FOMO just looking at like that heat map. I remember looking at stuff like that pre-pandemic. Like I for sure have that. It's impossible not to. So, if that type of stuff gets you excited, maybe take action. Take action. Take a shot.
Take a shot. I have FOMO seeing pictures of you hanging out with new friends down in Florida, right? Everybody's got FOMO. So take action. I'm not going to be moving to Florida to hang out, by the way. That's not me taking action.
All right. Let's see. Did we miss anything?
No.
Can I give a one real life actual scenario I have going on right now?
I would love that. I think that's
okay. Cool. So to talk about our refinance, our cash out refinance stuff. So I'm doing a refinance for a past client. I last worked with them back in like 2018. They're older, so they've been in their house for a very, very long time. Their home is in the Northeast, and They owe $270,000 on it. The house is now worth $550,000, as most houses have gone that direction. So they have a ton of equity. They also accumulated during COVID $102,000 of credit card debt. The current monthly mortgage payment is 18 something, called 1880. They pay $3,461 on their $100,000 credit. So their total payment for credit cards and mortgage is $4,692. We're making a new loan of $410,000 for this client. That's paying off their current mortgage balance plus their credit card balance and giving them $30,000 cash in hand. Their total monthly debt is now going to be $2,834. Their current total monthly payments is $4,692. I think I might have said that. I'm repeating it. $4,692 for their total payments right now. We're paying off everything and giving them $30,000. Their total monthly output's going to be $2,834. What's that save them a month, Al?
I don't know. I was hoping you would tell me.
$46.92.
Really, I was waiting for that punchline.
They're saving like $2,000 a month and getting $30,000 cash.
That's ridiculous.
And somebody might say, yeah, well, you're taking that credit card debt out to 30 years. Well, guess what? People aren't paying off $100,000 worth of credit card debt in their lifetime with the interest rates of 18, 20, 22, 24%. They're paying $3,461 a month on that credit card debt, and those are minimum payments. You can't get out from under that.
So that's the point, right? You're not getting out from under that. It would take you longer on minimum payments to pay that off than it would your mortgage, right?
Yeah.
And the amount of interest that you pay on that is astronomical. Number one, you cannot write that interest off on your tax returns. Number two, and number three, the only way that you're going to be able to pay a little bit more is if you somehow come into more money, right? And most people are on a fixed, have a W-2 job. They're not going to have a month where they just kind of fall into an extra $30,000 that they can put towards credit card debt. Right? So how are you supposed to manage that? How are you supposed to gradually pay that off? And you got into this position because you couldn't afford life. What makes you think it's all of a sudden become more affordable, so much so that you start to pay back the debt that you've accumulated? Those are the loans that, I mean, they make a significant difference in somebody's life. Now the problem is, right, trying to talk to that person about like, hey, you can't turn around and like, let's take the kids to Disney World. You know what I mean? Like, you're gonna have to let's keep some money in the bank. Let's be a little bit responsible. Pay off your credit card every month, build your credit back up, things of that nature. But that's a fantastic loan. Those are the ones you love to do.
Yep.
And how grateful that person is at the end of it. You know?
So, all right, cool. Well, I think that's a great show. I want to do those loans all day long. I love those loans. Those people, I mean, it sucks. They're in trouble. I mean, shoot, when I have a high credit card balance, personally, it stresses me out. I can't imagine that much
anxiety. They're thinking about that before they go to bed. They're thinking about that in the middle of the night when they wake up to pay. They're thinking about that when they get up in the morning. They're thinking about that all throughout the day. How am I going to pay these bills? How am I going to pay these bills? God forbid the hot water heater goes up, another credit card.
Yeah.
So the amount of stress that you alleviate when you're able to do that, it's amazing, man. That's amazing. Those are the ones. Yeah, I would love to do those to help people like that.
Yeah. So, all right, let's wrap it up. Let's get into the weekend. I'm going to get this uploaded to YouTube so people can watch. So viewer can watch.
We appreciate you. Yeah. We love you.
Where'd Al go?
We appreciate you.
Love and appreciate you.
Drop me back in.
All right. And we are gone. All right. Rough start. We pulled it together. Dude, you didn't say anything. That guy,